Welcome to our weekly roundup of key business developments in Sri Lanka. I'm Nishani Pigera. Let's first take a look at the main stories for this week. World Bank raises Sri Lanka growth forecast. Sinopec to double Hambantota oil refinery investment. And lending rates falls to near 2-year low. In our main story this week, on Tuesday, the World Bank raised its 2024 forecast for Sri Lanka to 2.2% from 1.7%. According to the bank's report, real GDP growth was also expected to strengthen further to 2.5% in 2025, with modest recoveries in reserves, remittances and tourism. According to Faris Haddad Zervos, World Bank Country Director for Maldives, Nepal and Sri Lanka, the country is on the road to recovery, but added that sustained efforts to mitigate the impact of the economic crisis on the poor and vulnerable are critical, as well as a continuation of the path of robust and credible structural reforms. The World Bank cautioned that downside risks remain high due to limited primary account and reserve buffers, especially with elections and policy fatigue, adding that there is insufficient deep debt restructuring. China's Sinopec will double investment into the Hambantota oil refinery to $9 billion. According to a spokesman for the Ministry of Power and Energy, the company has decided to double crude oil refining capacity. The refinery's construction will commence in June. The ministry also said that negotiations are being held on the provision of facilities for the refinery and also for Board of Investment facilities. The refinery will enable fuel to be provided at a subsidized price. The average prime rate fell below 11% for the first time since April 2022. The latest slide came as policy rates were cut by 50 basis points last week, bringing the total reduction in benchmark rates to 700 basis points since June last year. The central bank reiterated that banks should swiftly pass the benefit of the easing monetary policy to the borrowers. Sri Lanka Purchasing Managers Index for construction rose to 57.1 in February 2024. February saw a consecutive increase in new orders, underscoring improving demand conditions in the industry, driven by large-scale infrastructure projects and foreign-funded opportunities. However, the sector's employment contracted as concerns persist over the shortage of skilled workers. Moreover, there was a notable downward adjustment in construction material prices, enhancing profitability and driving momentum in construction projects. Sri Lanka's key inflation rate fell to 0.9% year-on-year in March from 5.9% in February. The inflation decrease was largely driven by a 22% reduction in power tariffs for households during the month. Food prices rose 3.8% from 3.5% in February, while prices for non-food items rose 0.5%. Inflation is expected to rise from April as a favorable base effect is no longer applicable. In our weekly tourism update, March recorded the fourth consecutive month of tourist arrivals crossing the 200,000 mark. 209,181 visitor arrivals were almost 70% higher than a month earlier. Arrivals in the year exceeded 635,000, on track to reach the 2.3 million visitor target. However, daily arrivals fell to 6,748 from 7,600 in February. India was a primary source market, followed by Russia and Germany. Meanwhile, Tourism Minister Harin Fernando announced that the pilot project of visa-free arrivals for 7 countries has been extended till 30th of April. Now let's take a look at the weekly movement of the All Share Price Index and the S&P SL 20 Index at the Colombo Stock Exchange. At the Treasury bill auction held on Wednesday, yields on 91 and 182-day maturities increased. Bids amounting to 207 billion rupees were received, of which 132 billion were accepted. The Sri Lankan rupee continued to appreciate against the dollar this week, with the central bank's indicative mid-spot rate ranging around 299 to 300 rupees. And with that, we wind up for this week. Do subscribe to our YouTube channel at the link below for regular updates on economic and business developments in Sri Lanka. Until we see you again next week, thank you for watching. Stay safe.